Welcome. In this video, we're going to discuss the accounting of interacting with your owners, or shareholders' equity. There's two accounts that you need to understand before we really get into the debit and credit details to understand shareholders' equity. The first is contributed capital. These are amounts given to the company by shareholders. They represent investment shareholders place directly into the firm. It could be cash, that's what it usually is, or it could be something else of value. But the main point is they've been contributed directly by the shareholders and given to management for management to use. Now, the other account may seem a little more complicated at first, but it's really not. And that account's retained earnings. So what retained earnings is the sum of all the value creation over the life of the firm, less any amounts that have already been distributed back to the shareholders. Another way to think about this is it represents the lifetime earnings of the firm that have been retained by the firm, thus that creative name that accountants have given it, retained earnings. But what does retained earnings really mean? Well, as value is created, the firm can either choose to return it to the shareholders, or it can be kept inside the firm so that it can be used for future value creation. If it's kept inside the firm, the way to think of this is it's really another investment by the shareholders. Instead of taking those assets back themselves, they let the managers keep them. And the managers use that to create future value. So just like the directly contributed capital, this is another way that the shareholders are investing in the firm, and thus another part of the firm that's owned by the shareholders. Now that we understand those two big accounts, let's take a closer look at how we do the accounting to get them. Let's start with contributed capital. And I'm going to use an example. So we've got investors, they give $150,000 to a firm to get 150,000 shares of stock. That is, they pay $1 per share. We're going to do two scenarios with this. In one, the stock's what's called no par value, and in the other, it's a par value of 10 cents per share. Let's start with the no par value. This is about as simple as accounting's going to get. When we do the journal entry, what we have to do is reflect what's happened to the firm. So as you can see, we debit cash for $150,000. That's to show that the firm now has $150,000 of cash. And then, like any journal entry, we need to say, well, where did that come from? It came from shareholders, so we're going to call that contributed capital and credit it. That lets us know that this is value that was put directly into the firm by the shareholders. Now, when we move on to par value, it's really no more complicated than that. We just need to add one more line. Let's start with the part that's exactly the same, the cash. We got the same $150,000 in cash, so we're going to debit that and show that on our balance sheet as an increase in our cash. So economically, this is really the same transaction, which means what we need to show in our credits is, where did it come from? Well, it came from shareholders. The only difference is that because this stock has what's called a 10% par value, we're going to say the first 10 cents on every share of stock is going to be called contributed capital. Across the 150,000 shares, that means there's $15,000 of contributed capital. Then the remaining 150,000, the 135,000 that's left over, we're going to call something like additional paid-in capital. You might see it called something different like paid-in capital in excess of par value or capital beyond par value. Any of those terms are just letting you know that this also came from the shareholders, and it's just something in excess of this declared par value. Notice that if you add it up, it's the same 150,000, and if you see these accounts on a balance sheet somewhere, you should just think of them all as being contributed capital. Now, about now is where you're asking yourself, well, why do we even bother with this par value? Why do we have this thing? I get that question all the time. The fact of the matter is, for the most part, it's just a historical leftover. It has very little economic impact. There's a few cases where it may matter. For example, when you first register shares, there's a tax for those new shares. If you have a par value, they'll use that par value to calculate the tax. If you don't, they'll impute it in another way. This is why you often see very low par values if you do see them. There may be a few other places where it matters, but really, for the most part, it's kind of like an appendix in a person. You probably have friends who've had their appendix out. They're operating perfectly fine without it. In fact, you may not even know that they had their appendix out as you look at them doing everything every day. Par value is pretty much the same. The company is going to operate exactly the same whether it had par value stock or not. Okay, now that we've covered the initial contribution of capital, we need to think about the next step, which is as the firm earns value, it's going to accumulate that value and then eventually distribute it out to shareholders. We're going to use an example here too. We're going to look at a firm that operates over 2 years, creating value in both of those years, a little more value in the second year than the first year. And at the end of the second year, they're going to go ahead and distribute some of that value back. So in year one, our firm creates $50,000 worth of value. That gets accumulated over the year in that account that we call net income. Now recall that what net income does is it captures all of the net value creation and destruction and sums it up and says, over the period, we've created a net of $50,000 of value. At the end of the year, we say, okay, that value's been created. We're going to pull it out of the income statement so that we can reset the income statement for the next year and reflect it on the balance sheet. And we reflect that in that account called retained earnings. So we move the $50,000 over, as you can see on the slide, from the income statement, and we put it into retained earnings. We didn't distribute any of that earnings back, so at the end of the year, we continue to retain all $50,000. You'll also notice on this slide, I've added a cash T account. We're going to assume that we started with $250,000, and throughout this example, I'm only going to show you the impact that our transactions with shareholders have on the cash account. Notice here in year one, since we didn't pay a dividend, there is no impact on cash. Now as we move on to year two, we create another $75,000 of value throughout the year. That gets moved over to the retained earnings and added in, so that in total we've created $125,000 of value. But at the end of the year, we've also decided to distribute $10,000 of that value back to our shareholders. So that amount's not going to be retained. We're going to debit that out of our retained earnings to come up with our new total of $115,000. That's the $125,000 of value created over the life of the firm, less the $10,000 that we've now distributed and not retained. Thus our retained amount of $115,000. Notice also that this is the first time cash is impacted. When we gave that value back to the shareholders, we gave it to them in the form of cash. So we need to reflect the fact that we have less cash at the end of the period as well. Now, I know some of you prefer journal entries, so here it is in journal entries. In the first period, we close our net income out by debiting it, and we move that over to our retained earnings with a credit. In the second period, we have net income of $75,000. We close that out by crediting it over to retained earnings. We don't impact cash at all until we've decided to issue a dividend. And at that point, when we give the dividend to the shareholders, we credit cash to show that it's been reduced, and we debit retained earnings to show that those earnings are no longer retained. There's two things that I want you to remember when you're thinking of retained earnings. First of all, notice that dividends never impact the income statement. Dividends are a transaction with our shareholders. And like any transaction with our shareholders, we're just moving value from one account to another. In this case, we're moving it from the asset that the shareholders call their investment in the company into the asset that's their bank account. And then they'll do with it whatever they want. So we haven't created or destroyed value, we've just moved value between assets that the shareholders own. The second thing is that retained earnings is an economic concept, just like net income is an economic concept. Net income captures the value created or destroyed during this particular period. Retained earnings measures all of the value created over the life of the firm that's been retained by the firm. It's not a big pile of cash. We all hear people say all the time, we're going to finance this transaction or finance this purchase through retained earnings, or we're going to use our retained earnings to buy this. But remember, when we created retained earnings, we weren't impacting cash at all. It doesn't represent cash, it represents an economic concept of total value created and still retained by the firm. I hope this has helped clarify these important accounts when we think about our interaction with our shareholders.